Welcome. I'm Liliana Rojas Suarez, Director of the Latin American Initiative at the Center for Global Development, and I'm delighted to moderate this discussion with four highly distinguished presidents of central banks from Latin America. Rosana Costa from Chile, Rodrigo Cubero from Costa Rica, Julio Velarde from Peru, and Leonardo Villar from Colombia. Welcome to all of you, and thank you for participating in this panel. Before we start, there are two housekeeping announcements I'd like to make. First, we have simultaneous translation into Spanish for those that prefer to hear the conversation in Spanish. Second, we'll be glad to include questions from the audience. Please send your questions by email to events@cgdep.org, or you can tweet at cgdep, or submit your comments in the YouTube chat. Well, let's start. It seems these days that the world is experiencing shocks on top of shocks. Latin America has not yet recovered from the impact of COVID-19, and we are now facing two new shocks: the Ukrainian war and the expected increases in interest rates by the US Fed. But even before the eruption of the Ukrainian war, growth prospects in Latin America were not encouraging. By the beginning of this year, both the IMF and the World Bank forecasted that, albeit with significant differences between countries, Latin America would have the lowest growth amongst countries in the developing world. The Ukrainian war has only complicated this landscape even more, since it's really having significant and severe impacts on global trade, have accentuated the disruptions in supply chains that were already present before the war, and have drastically increased the inflationary pressures that had also started before the war. In this environment, what we hear from analysts is that the projections for global growth have been downgraded significantly to just over 3% for the world, and the Eurozone highly affected, with growth being downgraded to just between 2.5 and 2.9% along that range. And for Latin America as a whole, consensus forecasts are just a meager 2% for 2022, with not much improvement for 2023. So in this context, let's focus our conversation first on the diagnosis of the problem. Let's talk first about the impact of the Ukrainian war on Latin America growth prospects. We know that there are two well-known channels of transmission that interrelate with each other: the commercial channel and the financial channel. In the commercial channel, the large increase in commodity prices, especially oil, metals, and food, are adversely affecting countries that are net commodity importers, with net exporters benefiting from a positive terms of trade shock. Of course, the increase in oil prices is adversely affected all countries. So let's talk about the commercial channel first. First question is for Governors Costa and Velarde. Chile and Peru are net commodity exporters. To what extent are your economies benefiting from this positive terms of trade shock? And what factors impede taking full advantage of this development? So, Government Costa, please. You're muted.
Excuse me. Thank you, Liliana. I am very glad to be here, and my salute to my colleagues also and the audience. First of all, I need to say that the invasion of Ukraine by Russia will have a truly high humanitarian cost, and I am very concerned about that, like all of us, and I need to mention this cost first of all, of course. Directly going to your question, the real channel, the first channel, very important for our country, is has two dimensions. The one is what happened with the price, with the term of trade. And in the case of Chile, we have a negative effect because our most important commodity is copper, and copper is increasing very less than the increase of the price of oils and some foods and other prices. So for us, term of trade represent for us a reduction in our external impulse. This is a real effect. And second, there is another real effect, is that we made export to European countries, and European countries receive the greater impact in growth. So both real channels are negative for us. This is real, and we have to recognize these two effects. So there is nothing like a favorable impact by this side. The second negative impact, very important for us, and I think that for all our countries, is overinflation. This was not mentioned by you, but this really is a great problem, because we were with very high inflation previously, and this is a new impact. Countries with high inflation, with expectation very high too, is another very important problem, especially in countries like the case of Chile, who is living an overheating in our economy behind this evolution of prices. Fortunately for us, the financial channel was less important in this case. The strictness in the financial condition was more important in European countries than in our case. And the last things I would like to mention is that in this case, in a longer term, could be very difficult for a country like Chile if we will live as a consequence of this event a sort of deglobalization. This could be a higher problem also, not only in the short time, but also in the middle and long term. We expect that this don't happen, but it's a concern too. It's something we have to have in our mind. I think that this point could be the ones I would like to mention in this this moment.
Thank you so much. Governor Velarde, your views on this, and as in Chile, is also the terms of trade a negative shock to you? Please unmute.
The concerns about that, but as was concerned about geopolitical instability in the world. No? Nobody was expecting this invasion. There are other areas in the world where we can also face some problems, but that's not the main issue in this conference. Yes, we reached an almost all-time high in terms of trade just some weeks before the invasion of Ukraine. Since the invasion of Ukraine, that terms of trade have been declining because of a greater increase in the price of grains and of oil compared to the increase in the price of copper, zinc, and other metals. And there is something different. While this increase in energy and foodstuff is affecting the capacity consumption of the poor people, the population in general, and probably limiting their capacity to spend in other items, the benefits of the increase in commodity prices will benefit miners and the government. The government will have more taxes, but the population to perceive that they have to spend well. And that is not always the case. So in principle, it's a negative shock on demand, I would say, and a negative shock on output. And of course, as was mentioned by Rosana, inflation is the biggest concern. We already, before the Ukraine invasion, had a very big increase in prices, the highest in the last 10 years because of increases in oil and commodities. And we were expecting to reach a peak on July and to finish this year within our target, below 3% of inflation this year. With the Ukrainian invasion, that has completely changed. Yes, to mention, this is the 5th time since we introduced at the start of the century inflation targeting that we are outside our target. But it's going to be probably the longest period. The previous period where we were outside our target for longer was for 21 months. Now we are going to be probably around 2 years. I don't know, 23, 24, 25, 26 months, no? And that is pretty hard. So as the phrase, we need rains, it pours, this shock has increased this this push on inflation that we're facing. And clearly, the invasion of Ukraine introduces a negative impact on growth and an impact on inflation around the world, I would say. I was here looking before this meeting in the inflation in Asian countries, which have been until now, most of them not so affected. But you see March compared to February, how they also been affected more and more. And probably, as was mentioned, in the case for Latin America, we have to increase the retail rate somewhat more also. No? I stay there maybe to answer more points in
yes. Thank you. And we'll definitely have much more time to talk about specifically about inflation and the way monetary policy is being used in the countries. Governor Villar, Colombia, has an additional problem, and is that it has significant financing needs. In 2021, the country was running wide current account deficit associated with a large fiscal deficit. How are the macroeconomic factors interplaying? Is the fiscal imbalance a drag on Colombia's growth prospects that adds to the shock from the Ukrainian war, so that it amplifies the shock?
Okay, first of all, thank you, Liliana, for this invitation. It's a pleasure to be here. And I would like to start by saying that I have a very strong bias towards saying that nothing good can come out from the invasion of Ukraine. Still, I will mention 3 very short-term positive elements that we can have from this situation in the case of Colombia. But I will stress later that the negative ones are much stronger, apart, of course, of the humanitarian effect of this war. But the fact is that Colombia is an oil and coal and nickel exporter. And those 3 items, those 3 commodities, have had very large price increases as a consequence of the war. And that can help us in the short run to improve our terms of trade, to increase the prices of our exports, and indirectly to improve also fiscal accounts. So in that sense, we will be reducing the financial needs for the country and for the government. In addition to that, there has been a strange situation, which is a rebalancing of portfolios around the world, out from Russia, of course, and from Ukraine, and from other countries in Eastern Europe, which could be eventually affected by the conflict. And those portfolios are going to other emerging markets and are looking for countries with the characteristics that could be more similar to those of Russia. So commodity exporters, oil exporters, nickel exporters, coal exporters, like we are. So in that sense, in the very short run, we are benefiting from that type of rebalancing of portfolio. And that explains why we have experienced during the last few weeks a significant appreciation of the currency. The Colombian peso has appreciated by about 2.5-3% during the last month, and if you take it from December, by more or less 6%, which is significant. Now, the bad part of this story is that all these positive impacts are very short-term ones, and what I am afraid is that the impact on the prices of Colombian imports of food and of agricultural inputs will be much stronger. We are in a situation in which inflation is high, is more or less the same as the US, 8.5%, but with food prices rising by 25%. That's a very strong impact, not only on on headline inflation, but also on the distribution of income. And this impact of the war may increase food prices even more and make the reduction in food price inflation that we were expecting it to start by May this year much more uncertain, and that may make it much more difficult to control inflation expectations and to bring inflation down to the initial levels. Also, in the medium run, the war may have an impact on the global financial markets that may force the US and other advanced economies to tighten monetary policy even more than would have been the case otherwise. And that can affect us in a context of more risk, so that could produce a shift of in the long run, a shift of portfolios and of capital from emerging economies towards the US, contrary to what is happening in the very short run. And I also see a very difficult risk that, as mentioned by Rosana, this situation may lead to as she said, a deglobalization, a more segmented global trade, world trade, which could affect productivity and affect our capacity to grow in the future.
Okay, thank you so much. The issue, we are definitely going back in the next round after I pose a question to Governor Cubero, but we're going definitely into a discussion on capital flows and again on inflation that I can see you all really willing to be discussing much more. I'll turn to that in a minute, but before Governor Cubero, Costa Rica has made improvements in its fiscal stance, no question about that. But the debt ratios are very high and a source of vulnerability. So at the current juncture, Costa Rica is in the difficult position of being a net importer of commodities. It was in that situation before the war, right? So this has just accentuated the situation. What is the country growth prospects in this scenario where you have many of the numbers not really working in your favor?
Yes, thank you very much, Liliana, and thank you, CGD, for the invitation and the opportunity to share this panel with my colleagues from other central banks in the region. Yes, Costa Rica is a net commodity importer, and so obviously this shock is a negative one in all dimensions that have been discussed, inflation and output. Of course, for Costa Rica, particularly negative. We were already facing negative terms of trade shocks since 2021 and expected a further deterioration in terms of trade in 2022 before the war. This has now only exacerbated what we had already projected in terms of the deterioration. in the terms of trade. So the projections that we had for growth in 2022 were slightly above potential, which we estimate in the central bank at 3.8. It was 3.9 for 2022 before the war. And that was on the basis of a recovery in the tourism sector, which is an important sector for the Costa Rican economy, which has not really reached to the pre-pandemic levels. It is the one lagging sector. Basically, the rest of the sectors in the Costa Rican economy have recovered to pre-pandemic, but not tourism. So the bounce back in tourism closer to pre-pandemic, perhaps not fully back to pre-pandemic in 2022, was helping the economy in our projections back in January recover faster than potential. Now with the war, we're certainly in the process of revising down, unfortunately, our growth prospects, and we would probably have to bring it down to something. I will not anticipate what it will be, but I think it will be of the order of 50 basis points, so half a percentage point. So we're talking about 3.4, 3.5 probably for the year 2022. So a significant downward revision. And we were already, Liliana, as you mentioned, in the process of fiscal consolidation. So throughout the pandemic, instead of having a counter-cyclical fiscal policy, we had to engage in pro-cyclical fiscal policy consolidation as a result of the already high level of debt that the country had before the pandemic hit. This situation that you have described now, the war in Ukraine has brought about, basically an increase in international interest rates, will only worsen the financial conditions that the government will be facing in international markets as a base. Now, of course, for any country, emerging market or otherwise, particularly for our countries, the interest rates that you pay in international markets are a function of the floor rates, say risk-free rates, particularly treasury bond rates, but then the risk premium. And that risk premium will probably go down for Costa Rica if the fiscal consolidation policies continue to be in train and on track. And we are at the moment supported by an IMF program, which I think will help ensure that that's the case. But certainly this is a negative shock, and this will counteract or offset the gains that we were expecting in terms of interest rates from fiscal consolidation. So definitely a very challenging time for a commodity importer like Costa Rica with a high fiscal deficit.
Yeah. Thank you so much. This is a perfect introduction for our next round of discussions, which basically deals with the complexity of the global financial environment. Now, we were talking about the trade environment and the points that first Rosanna made and then was subscribed by all of you was this point of the challenges of the globalization, right? But if we now move to the financial channel, we know that investor risk perceptions associated with the uncertain evolution of the Ukrainian war has increased, and you have all mentioned that. Capital flows to emerging markets are influenced by investor risk sentiments, but also by the return from emerging market assets. If the yield offered by emerging market securities relative to those offers in advanced economies remain high, the jump in risk may be partially observed by high yields containing potential capital outflows, at least in the short run. And that's why we've been seeing that the global liquidity still remains high. And this is reflected in the negative real interest rates in the US Treasury bonds at all maturities, right? Now, this is, again, in the short run. This can change very quickly, since the Fed, as several of you have mentioned, can react to the recent high inflation numbers through sharp and sustained increases in interest rates. So these two, Governor Villar and Cubero, given the fiscal stance in your countries, because these two countries are, countries where the issue comes very quickly and very, upfront in the discussions, are you concerned about a potential reversal of private flows to your economies in light of the Fed's policies? So let's start with Governor Villar.
Sorry. Well, yes, of course, there is a concern and there is a risk about what may happen with the flows to the private capital flows to the country. We need them because we have an important fiscal deficit and we have an important current account deficit. The current account deficit of Colombia last year was among the highest in the region. It was 5.7% of GDP. It is expected to be much smaller this year. We were forecasting it to be a little bit below 5% of GDP, but with the recent events, it may be perhaps 1 or 1.5 percentage points lower than that. Still, we count on important capital inflows, both to finance the current account deficit and to finance the government, because the fiscal deficit is around, should be this year around 6.2% according to the official figures. That number can be reduced also because of the higher oil revenues. But in any case, we'll have a process of adjustment that will take place during several years to get to a steady state of lower fiscal and current account deficits. So in that process, capital inflows will be essential. We have to keep confidence, and for that purpose, it is very important to have a global financial world that is not much biased against the emerging markets as ours. So in that sense, it is very clear that is a concern. We hope that the US can make that judgment in an orderly manner, and so that the increase in interest rates is not too sudden, too sharp. But of course, we are all praying that can be so.
Yeah, that is one of the issues that I'm sure is going to be debated during the spring meetings, right? I mean, for some time now, there has been calls about as to whether such a country like the US and such a central bank like the Fed should in any way internalize the spillover effects of its policy over the rest of the world. That was a big discussion in 2000, after the global financial crisis, and that discussion has come back again, right? And when you say, let's just pray, I mean, one wishes that we can do something more than just pray. But
well, of course, we are preparing for the worst always, but we also expect the US can do it orderly.
Yeah, so Governor Cubero, your views on that?
Sure, and let me just refer briefly to this issue of spillovers. I was at the IMF at the time of the global financial crisis, and of course, one of the main discussions was whether the US would be able to take into account not just the spillover effects, but the spillbacks from those spillovers. So if there is a negative effect on trading partners for the US, how will that affect the US economy? So spillbacks became an important part of that discussion. So we should also frame it in that way when we retake that old debate. It's old because it's now 14 years old, but certainly is very present. So regarding the question, let me just start by saying, Liliana, that in the case of Costa Rica, the commercial channel is probably more important than the financial one. And we depend a lot on the US as our main trading partner. It's also the main source of tourism flows. It's also the main source of foreign direct investment for Costa Rica. Now, within the financial channel, FDI, foreign direct investment, is probably more important than other financial flows. And FDI is not that dependent on interest rate differentials, but it is more dependent on growth. So from that perspective, we already have a negative shock in the making. If the US economy slows down significantly, as is expected, particularly in negative scenarios where the Ukraine conflict lasts for longer than any of us would hope. And that is already kind of compounding the other negative effects from the stagflationary shock that we're facing globally. But within the financial realm, certainly the fact that the Fed is raising rates will put even more pressure on domestic rates. We have been facing a process, an underlying process of diversification of the asset structure of pension funds. This has been taking place over the last 5 years. So pension funds have been actually increasing their presence, the share of foreign assets. So the net foreign asset position of the country is changing as we speak. But this will only exacerbate that, and that will put even more pressure on the exchange rate, which will exacerbate the pressures on inflation. This is something that is clearly an aspect that differentiates Costa Rica from our other central banks here in the panel, in the sense that we're not seeing an appreciation of the exchange rate because we're net commodity importers. Mm-hmm. So the effects on inflation are worsened and not offset by currency movements, as opposed to what happens in some of the other countries in the panel. This is all to say, Liliana, that unfortunately for the case of Costa Rica, I mean, we have many structural strengths, of course, but and we hope that, for instance, FDI will continue to be strong. But to the extent that we face these headwinds, we will definitely have a difficult year. And let me just before I finish say that part of the concern is something that our colleagues have mentioned before, is the distributive effects of these shocks. Because particularly in the case of our countries, food inflation will go up, and that will hit the poorest hardest. And certainly we're seeing inflation of the order of 9.5% in food items in Costa Rica, where inflation, actually headline inflation, is relatively moderate by regional standards. By food inflation is at 9.5. So certainly very regressive effects from this combination of shocks, and we're very concerned about that also.
Thank you so much. Governor Costa, you might want to add into this discussion about the spillover effects, but also in the case of Chile, I'd like to know your views about what some analysts have been identifying over the last years as a vulnerability, a financial vulnerability arising from the large levels of corporate debt in Chile. In the context of rising international interest rates, that might increase the risk of refinancing outstanding obligations. Are you concerned about that at all?
Thank you, Liliana. We have always to be a little concerned about the level of debt, and after a crisis like COVID-19, of course, many firms have a more vulnerable position than traditional, than in normal moments. Of course, this is something important, but our exercises of financial stability shows us that we are in a good position. We have this problem very concentrated in little firms in some spaces of the market, not more than that, and that the bank situation is very solid today. So I think that this is not necessarily our most important concern today. I think that it is much more important the first question answered by my colleagues. What could happen, for example, not only if with a strictness position because of regularization of the Fed fund rate, but what could happen if in one moment the market think that what the Fed is doing could be not necessary, and we live a more volatile situation in the global market. This could be a more higher disruption. We were living in a very uncertainty condition about what could happen with the movement of higher or development countries with their monetary policy rates. We are living a moment with very high inflation. We know that they were in just beginning with a regularization of their monetary policy. They need also to tighten, to make quantitative tightening. This is territory not with no much we know that in the past, this didn't move exactly the rate in the position or in the direction we were expecting to do. So this is a very uncertain reaction of the market related to what happened in this case. And in this opportunity, as a difference to another opportunities in the past, the caution provided by Chinese growth is likely to be absent. In the past crisis, emerging market was favored by the position of the growth of China, and in this opportunity, this will not be the case. They were living a very delicate situation because of COVID. They are making very high lockdowns, but also they have a housing sector with not good health. So in other opportunities, when they applied counter-cyclical policies, they use this sector a lot. And I don't know if in this moment, this sector is in a good position to do something like that again. So this caution probably is not with the same strength than in another opportunities. So we think that the risk of what happened with the rate, for example, the Fed fund rate, is very important. What will be the response of the market to what the Fed do day by day? What will be the effect of quantitative tightening? This is a very uncertain situation, and this could be very, very. This is a worry for us. I think that this focus is more important than what is happening with the stability situation, the stability of our financial market. When we look carefully what is happening with the firms, with the bank system, with the financial market at all. This is a focus more important now because it's very uncertain and could produce high volatility in some conditions in the future or the near future. I think this is a more important topic to be very careful of what happened. And in our case in particular, when situations like this happened, we permit our exchange rate to move and to absorb part of the cycle. And in this opportunity, we are living a special condition inside our country, who is producing that our exchange rate is higher than normal and moving because of another factors, not only market elements. And this could make the situation worriness. And this is the reason I mentioned in another level this risk today.
Thank you so much. There's a lot to take from your remarks. Governor Velarde, Peru's external debt ratios are low by international comparisons, and the central bank have a lot of international reserves. In this context, what are your concerns about the impact of potential large increases in the Fed's rate? I mean, most of your colleagues in the panel have put forward their particular concerns. What are yours?
Well, I agree with them mostly. I would say that I have been longer in these meetings than other governors. What I have seen in the last 10 years when this issue was discussed, spillbacks, etc., that Rodrigo remember me, the position of different governors of the Fed has been, of course, we are concerned what happens with the marine markets, but at the end, if we manage appropriately the American economy, the interest rate probably will be good for the world. So actually, I believe we're not going to affect their decisions. Now, compared to May 2013, when the tapering was announced by Bernanke, I believe we're in a better position. At that time, other currencies probably were too appreciated, probably even overvalued compared to fundamentals. Also, now we have been increasing the interest rate rather aggressively compared to other regions, most of us. And third, I believe that, particularly last year, I was seeing the flows to to Latin America, except to Colombia, where there was an increase in most of their countries. There was less appetite for bonds in the region. So it was not something idiosyncratic for the countries. It might be more accentuated in Peru because of the political situation, but it was a common phenomenon. What we have seen in our case, the fiscal situation has improved dramatically. The fiscal deficit was 8.9 in 2020. Now it's 2.6. It was 2.6 last year. Now last 12 months is 2.3, so it has improved a lot. And probably the needs of financing this year will be very low, because in part, we issued paper on November last year that is supposed to cover a good part of the expenditure this year. So our problem last year was outflow from residents. Mm-hmm. It was the highest in our history, 7.2% of GDP. What we're going to see probably is the volatility that was referred by Roxana. It's very hard to know the consequences of the decision of the Fed in the future. In the future, I would say the next meeting, not only this meeting, because it will affect probably a lot of prices of different assets, not only our paper, our government paper or corporate paper, but also the price of stocks around the world, the price of bonds around the world, etc. These movements in relative prices may also have some effects on not only on flows, but even on economic activity in the world. It's something, since Greenspan put, since what was called the Greenspan put, the Fed has almost acted as a following the market, let us say, in a certain way. Now it might be somewhat different, and we have not had that experience in that, at least in the last 20 years, no?
Yeah. Thank you. Your remarks reminded, you mentioned the temper tantrum, the May 2013 event, where the expectations of the removal of the liquidity support by the Fed brought significant movements in capital flows to emerging markets and currency depreciations, as well as increase in the MBS spreads. We have not yet observed that. I mean, there are no indicators at this point that are pointing there. Yeah, go ahead.
And we haven't seen the inflows.
Correct.
For that. Actually, we were purchasing $12-15 billion every year, so the currency didn't appreciate so much, and in spite of that, they appreciated 40%. Those inflows have not existed, so they are going to reverse because they didn't gain in the last years, no?
Yeah, that's a very strong point. What can come in, what can have not come in cannot go out, right? Yeah. All right, so moving on to the core of your functions, right? Inflation and the effectiveness of monetary policy. You all have mentioned this, but for our audience, let's remind that rising inflation has indeed been a global phenomenon that has been exacerbated by the Ukrainian war through the effects on the oil, on the prices of oil, gas, and notably food, as you all mentioned. This inflationary pressure seems to be persistent. I mean, they are expected to last for at least most of this year. You have all been really busy quickly reacting ahead of the curve, ahead of the Fed, through consecutive increases in interest rates. Here, it would be great to hear your views on two issues: the effectiveness of central bank policies and the management of the inflation-growth trade-off. So let's start with Governors Velarde and Cubero this time.
Sure.
Are inflation expectations anchored in your countries? Are there factors that may reduce the effectiveness of these policies? First, Governor Velarde, please.
Sure. Inflation expectations have been increasing as inflation has been increasing. They are below headline inflation, or headline inflation is 6.8. And expectation of inflation are a little less than 4.4. Our concern has been how it has been expanded, this, I would say, supply shock into other prices. On February, 63% of items were above 3%. On March, 70%. I have been increasing since less than 20 before, no? And you see something similar. I don't know the number for March in the States, but in February it was 60%. It probably continues increasing, probably around the world. What we are concerned is how this expectation may become of high inflation may become more permanent, and that's our main concern. Of course, we know that it's mainly supply-driven inflation. The problem is how they contaminate the prices, how they affect expectations. It's very hard to know. As I mentioned, this is going to be the longest periods where inflation will be outside our target. How will that affect expectations? We believe not so much. When we ask for what they expect for inflation 2023, 2024, they are still pretty well behaved, those inflations. But that can change pretty quickly. And one has to know. Just to finish, it was actually not a surprise. Until July of last year, we were within our target. Since August, it started to increase a lot. And since August, we started increasing the rate. We increased 25 basis points and then 50 every month. Now we're in 4.5. But your question was trade-off between output and inflation. We are below the neutral rate. Of course, it's hard to know where the neutral rate is. Our estimation is 1.5. We are not so concerned while we are below the neutral rate. Consumption is still pretty strong. I have received the number for manufacturing in February. We're expecting 2.7 is more than 6%. So we still have some sectors that are growing pretty strongly. What we know and we have learned from the past, once inflationary expectations get anchored, is the worst situation possibly for growth and for economic activity. Just to finish, with hyperinflation, it took more than 30 years. We recovered the GDP per capita of 1967 on 2003. And it was only the effects of hyperinflation that causes an hyper recession, if you want at the end. No?
Yeah, those memories of the past are quite painful for many of the countries in Latin America. Governor Cubero, your thought on the anchoring of inflation expectations?
Well, I fully agree with Governor Velarde that it is actually very difficult to know what's going to happen with inflation expectations in 2023 if inflation indeed remains a lot more persistent than we are now projecting it to be. Now, in the case of Costa Rica, inflation was, before the war in Ukraine, was projected to remain within the inflation target range of the central bank, which was 2 to 4%. Our target is 3% with a plus minus 1% tolerance band around. It was getting close to the upper bound, like 4% before the war in Ukraine. Now our projections are suggesting that inflation in 2022 will probably burst the 6% rate. And on average for the year will probably be at 5%. Inflation expectations have gone up as a result of that. They are now at 5% for the 12 months ahead. And that's more or less in line with our projections, which is fine. That is good. And it's actually below observed inflation, which right now in the month of March is at 5.7%. So that is fine. But as Julio was mentioning, the critical question is whether expectations will become more difficult to anchor back to the inflation target if inflation remains a lot more persistent. Now, of course, the very stagflationary nature of the shock suggests that the inflation output trade-off will be worsened in the next few months, and we will be contending as central banks with that difficulty. But it is critical also for us to be able to anchor those expectations. So if there is a reason for a country like a net commodity importer like Costa Rica, which now we got into the Ukraine war with a slightly negative output gap, the war will only make it worse. So there is no immediate reason to go to a restrictive monetary policy stance. At most, you would probably expect that you would normalize back to neutral. We're way behind neutral. We are in expansionary territory still. But the question is, given that the nature of that shock, is it justified that you go entirely to neutral, let alone to restrictive? My view is probably not. But the issue is you have to contain inflation expectations, because otherwise the inflation output trade-off will certainly worsen a lot more, as Julio was mentioning. So this is the critical issue. And for us, we see that acting now on the monetary policy front, and we've been tightening already. We will continue to tighten. We have been providing forward guidance on this, and clearly we have already, with the war in Ukraine, intensified the pace of tightening. The main reason to do that is, if anything, to actually act on expectations, which is the channel that would probably affect the most inflation over the medium term, and particularly the inflation output trade-off, as you mentioned. Yeah. A second channel for us that justifies also acting at this point is the exchange rate channel. And as I mentioned, in the case of Costa Rica, we have a perfect storm putting pressure on the exchange rate as opposed to the other countries here. So we definitely have to act to contain inflation pressures coming from the exchange rate channel. The other channels of monetary policy, perhaps a little bit less important, and we are, in fact, concerned about the recessionary impact of these shocks, and even the recessionary impact of monetary policy. But it will be even worse if we don't act right now. And that is why I think our central banks are doing well in acting in advance. And let me just stop by saying that I think our monetary policy has been ahead of the US. So in this case, we're not just reacting to the US. I think we've been acting ahead. And in that sense, if anything, I think Julio suggested that perhaps the Fed is following the market. Certainly, I think they are following inflation a little bit behind what the central banks in most of Latin American emerging markets has been. So we are ahead of the curve, if anything.
Yes, certainly. I mean, that's something that has been noted by many analysts around the world, the fact that Latin American central banks have been actually proactively acting to the inflation and ahead of the US. So Governors Costa and Villar, do you agree with these statements? Although the clear objective of the central bank is to control inflation, how are you managing the effects of increased interest rates on economic activity? Is there a role of central bank communication efforts to ensure that your institution can conduct its function while minimizing the public's complaints about increasing financing costs? So Governor Costa, please, first.
Thank you, Liliana. Thank you for the question. It is very challenging to communicate to the market when you have the inflation at the level of 9.4, you have a goal of 3% 2 years ahead, and you have expectation over the goal at 3.7 if you ask economists, and if you look the market prices, very higher, more than 4%, with some risk premium when you have this level of inflation, but it is very difficult to communicate what are you doing, especially if you have a very high overheating in your economy. Past year, our economy increased 12%. It is clear something not, it is not in equilibrium. Our economy, clearly, we have a deficit of current account of 6.6% of the GDP. So it is very important to react with monetary policy and with fiscal policy too. We began increasing our monetary policy rate on June, July of past year, and we have increased it 650 basis points. And we continue having this level of expectation of inflation. We are just looking some reaction in the direction of the economy. We were looking some negative increase in the past months when you compare months to months. So economy is reacting. But what we are trying to maintain very clear is in our communication is that we are reacting to inflation, to the projection of inflation, and not necessarily to the level of expectation. That doesn't mean that expectation is not important, but we are not competing with the answer of the market in the expectation level. This is very important to to have this clarity. And also we are being very clear in what and how we are analyzing expectation of inflation too. And in our last report, a key issue for us is if these higher inflation expectations are indeed affecting the behavior of prices by the side of firms and households. This is a new topic for us. We have no long experience as other countries in these topics. Our analysis up to now suggests that this is not the case, that inflation is behaving according to its traditional determinants. We also have gained additional insight for new surveys conducted by the central bank and asked firms about the process of price formation. In these surveys, agents says to us that they expect the current inflation level of inflation will abate and return to normal during the 2 years, which is a welcome development. Nevertheless, we have assumed in our latest forecast that inflation will exhibit a more persistent pattern than usual, precisely because it is high and keeps increasing. And in summary, we are committed to closely monitoring inflation expectation, and we communicate all this evidence very clear that we were reacting more than what evidence suggests, because we have a very high inflation and we have time to react in the other direction, and that our goal is continue being our goal. We are not living at the side the goal because of the level of inflation, and that our reaction will be the same, or the reaction we need for the convergence of inflation. So we are trying to be very transparent about what we are looking with about expectation of inflation, the analysis we are doing, and communicating that it is very important, but our goal is inflation, not expectation. I think that both topics is important in our communication now.
Thank you so much. On this round, Governor Villar, if you can be, so that we have space for another round of questions, you can be relatively brief.
Sure. Well, I think in the communication of monetary policy, there is something that is very useful, and it's a characteristic of monetary policy during the last 20 years or 25 years in South America and Latin America, which is countercyclicality. We have been able to keep our monetary policies countercyclical during these years. We were very strongly countercyclical during the COVID crisis, and today we can explain that we are again countercyclical because economic recovery has been much faster than expected. In the case of Colombia, we grew last year by 10.6%, and we are expecting GDP growth to be more or less 4.7% in 2022, and most analysts expect even higher growth for this year. So in that sense, we can manage communication about our role in keeping inflation down, in looking gradually for the inflation target, but at the same time in stabilizing GDP growth. The problem is that with this persistence and the magnitude of the supply shocks, the calibration of monetary policy may become much more difficult in the future. So we have to be very careful about how to manage that. We keep saying that we will be acting in a data-dependent manner, so that these trade-offs can be well managed, and we can reduce inflation towards the target in a gradual way, while keeping growth going well.
Thank you so much. I know there's so much to discuss and so little time. We have time for one more round of questions, which it's impossible not to touch upon the idiosyncratic political events that are affected economics analysis in Latin America, and therefore the role of the central banks. The 4 countries represented in this panel are having important political events. Costa Rica just elected a new president last week. Chile's new president started his mandate last month, and there's an intense debate about the proposals in the new constitution. Colombia will have new elections next month, and in Peru, political tensions are red hot, with calls for the president to resign. So, briefly, because we don't have too much time, but these are idiosyncratic questions. So, Governor Villar, Colombia is well known for the strength and independence of its central bank. Do you think that the strength of the central bank as an institution and its credibility is secure regardless of the electoral results?
Yes, I'm quite sure about that. And I feel that any candidate that can win the election will respect the Constitution and will respect the autonomy of the central bank. There are huge differences among the candidates, but the institutionality in Colombia is very important and very traditional. So I'm very much confident that that institutionality will be respected.
That's great news for Colombia and the region. Governor Cubero, the party of President-elect Rodrigo Chavez has a very small representation in Congress. In many other experiences in Latin America, this has been a strong source of tensions in the design and implementation of policies. What are your views regarding the main challenges for the central bank in this context, especially if it needs to significantly increase interest in the near, short, and medium term?
Thank you, Liliana. Well, like in the case of Colombia, I expect the central bank independence to be respected by the incoming administration. And certainly, we have institutional backstops to ensure that that is the case. So I think institutionally and given the understanding of the president-elect of macroeconomics, I would hope and certainly expect very strongly that he will abide by the keeping of the autonomy of the central bank, which is crucial. Not just to of course, be effective in containing inflation at the current juncture, which is very challenging, as we have described throughout the last hour, but certainly also to be able to remain a voice of wisdom in turbulent times. And I think that is also a very important role of the central bank. Now, the parliamentary composition shouldn't really alter that much the way we act at the central bank. It will be a challenge for fiscal policy, and I think that is something that will certainly come to affect the macroeconomic balance. But Costa Rica should continue on the fiscal consolidation path that it has already begun 4 years ago, and I think this is the essential, I think, piece of macroeconomic policy going forward for the next administration. We at the central bank will continue to do our job. Certainly, we are facing a difficult time, and I would like to just stop by saying that in the case of a country like Costa Rica, it is not clear to me that yes, Leonardo, we have to be countercyclical, but in the case of Costa Rica, we're probably being countercyclical by remaining expansionary at the current juncture, given where we are. I mean, this is not just because of what I mentioned before. That the output gap is actually negative and being made more negative by the stagflationary nature of the shock that we're facing, but also the fact that inflation is completely imported. I mean, the issue when you look at inflation, Costa Rica headline is 5.7, but when you look at the composition, service inflation is only 1.7. This is not the cause of overheating in the Costa Rican economy. We're not facing demand pressures. It's an entirely imported inflation. It's different in different countries. I know Chile is probably an example in the other direction, where fiscal and monetary stimuli have been extremely important in strengthening aggregate demand. In the case of Costa Rica, is monetary policy actually acting in a countercyclical way to offset fiscal consolidation? So in the net, we're definitely not having overheating as other economies. We're facing rather recessionary pressures right now. So, so the role of monetary policy here is if anything, to calibrate, as Leonardo said correctly, how to reduce the possible negative effects on the inflation output trade-off from an expectation, the anchoring going forward. And this is how we have to work very carefully to reduce the recessionary impact, but also to contain inflation expectations. And clearly, the key instrument for this is communication, as both Leonardo and Rosana have highlighted. I fully agree with that. We have to be very deft at communication. Thank you. Yeah.
Thank you. Governor Costa, Congress is considering yet one more withdrawal from pension funds, a policy that has been widely criticized as myopic since it doesn't take into account the long-term effects for the development of the financial system and the ability of the population to ensure adequate funding during retirement. If this policy were to be approved, what in your view would be the effects on the stability of the financial system and on the fiscal stance?
Well, it is a very important question. We have seen in three other opportunities a withdrawal from the pension funds, and the effect of each of them was increasing because the market is not so strong at the first time, and because the effects probably are not linear. And in this case, we were reopening a debate that we suppose closed after the third withdrawal and with a new government. So it is a very it is a very important shock of uncertainty to the market. So this is one very important channel. Uncertainty is very important. We were living a very uncertainty process, political process, constitutional process in our country, and these policies by the Congress or whatever is a very bad news in this sense. The effect, the most important effect, is that the Chilean economy has a very particular characteristic. We have a very strong financial market, and this strong financial market has a very important agent, and this is the pension funds. This pension fund is strong, is long-term saving, and is have proved to be a very good stabilizer of the market. So when we decrease the importance and the size of this agent, we are attempting with this strengthen in our financial market and with this stabilizer of the financial market. So we need to close this discussion. We need to sit all the agents, politicians, congressmen, and to debate at the end what we are going to do with our pension system, and not to continue jeopardizing our financial market. It is a very important characteristic. It's a strength of our economy, and we need to stop with this class of propositions and this type of financing public policies. This is not the way to finance public policies or people needs. So this is my answer.
Yeah, I saw that was a very important question to raise, because Chile has been the example not only for Latin America, but for the rest of the world in terms of the success of the pension fund system in the country. And so, weakening that strong institution, is a major problem for Chile and the region if they see the collapse of an institution like that.
Yeah.
Governor Velarde, how are the strong political tensions in Peru affecting investment and growth, and are they complicating the conduct of monetary policy? You're muted.
I wouldn't say so. we have gotten used to these political tensions in the last 2 years, I would say. And even before the impeachment process affect the exchange rate or the price of the bond for 1 or 2 days at most. Now it has been somewhat more protracted, but mining investing is pretty low because they announced a new tax and they have not announced what it will be or if there will be or not a tax. But other sectors, investment is going to be in dollar terms higher than last year. In real terms, it has been growing 6% compared to 2019. 2021 was a little bit high because it took part of the amount of 2020. I would say the main concern of many of the businessmen when this government was elected were that many of his campaign promises were pretty radical. I believe a reality check when he saw these big outflows of money from the residents, the pressure on the exchange rate, etc., has moderated somewhat his position. And also he faces an opposition by Congress. The Congress is controlled by the opposition, so he cannot push for a lot of measures. And his popularity is pretty low. It's slightly above 10% now. So actually, his capacity to introduce radical measures are limited. And because they are limited, probably the business confidence has not gone down so much, no?
All right, thank you. We are practically running out of time, but I don't want to finish this before giving each of you a 1 minute opportunity for intervention. The meetings, the spring meetings of the IMF and the World Bank are, upon us. Based on all the different discussions that we have been having today and the different wonderful, actually novel issues that you have put on the table, what would be your most important comment or, I don't want to use the word advice, but what do you think is a topic that should be at the center stage of the discussion during the spring meetings? Anyone would like to take the first word?
I believe inflation is the main concern around the world. And second, how the Fed is going to react to that and how it will affect the world, the markets in general, no? I believe that will be a good part of the discussion, no? And of course, those events related to specifically to the war between Russia and Ukraine, no?
Governor Cubero.
Thank you, Liliana. I think that of course, one of the key concerns is what Rosana mentioned at the beginning, deglobalization. I think multilaterals have to focus on avoiding a breakup of the trading system, but also of the global financial system, which is also a risk with the sanctions on Russia. We now face a risk that Russia and China may form a different financial bloc, which may actually come to subvert the financial globalization process that has so much benefited the world in different ways. Of course, we know that there are risks also involved, but this should be one critical area. I think a second critical area of discussions in the spring meetings should be how to avoid countries getting into locally, nationally, or globally counterproductive policies, particularly protectionism. Export restraints, we're seeing discussions on that. Fuel subsidies is one of the first discussions that many parliaments are now engaging in to sort of cushion the impact of the terms of trade shocks. We're seeing that in Costa Rica is a main risk, but that is not the main. That is not a good response. We know that a good response should be actually increasing targeted transfers to vulnerable households. Fuel subsidies are regressive and are inefficient, and so we should avoid them. So I think the multilaterals play a critical role in trying to stem counterproductive policies at the national and the global level.
Yes, and adding to that, there has been a lot of analysis this day trying to refocus or focus the attention from subsidies to targeted support. Right? I mean, there has been a lot, it's not being really taken so much by the governments, but that is the global advice these days. Government Costa, please.
Well, I will mention also inflation, deglobalization, or in another word, what will be the way we are going to rebuild supply channels between areas around the world. What will be the future of this way to reveal these supply channels? And the third one, I think, will be what will happen in Europe with the provision of energy? What will be the future of this solution, thinking in climate change? I think there is a very huge question too, and very important for one country producer of copper too.
Yes, absolutely. Absolutely. Governor Villar, I have to give you the last word.
Thank you. Well, I entirely coincide with the topics that have been mentioned by my colleagues. But I would think that the main issue is the trade-off between inflation on one side and tightening of global financial markets on the other side. Of course, as happens inside each country, one always want a very liquid financial market, very expansionary policy from the advanced economies, but at the same time, it's very important to keep inflation under control. So that trade-off is very important, and in this moment, I think the emphasis on inflation and how to control inflation without harming too much the global financial markets is the key.
Okay, thank you. And thank you to you all. I think this has been a fascinating panel. I've learned a lot, certainly. And I know that the audience must be really, really fascinated with the discussion. Thanks again, and goodbye to all.
Goodbye. Thank you.
Thank you very much.
Bye-bye.
Bye.